Mike, you're expecting 50 basis points of cuts by 2021 from the Fed, and that makes you bullish on Treasuries. Why so dovish?
Our growth view is 1.5% for 2020 versus a consensus of around 2%. And the prime reason that we're looking for that is that we see the slowdown that we've seen this year feeding through into the US consumer. We're not looking for the US consumer to hit the brakes dramatically, but we think there will be some sort of slowing of the consumption trends that have been evident. And that's enough to then spread out to the wider economy. You're not going to get a big boost to exports or business investment from the US-China trade deal. You'll get a little bit of help, but you're not sort of talking wholesale reversals of previous tariffs. All you're talking about is a modest reversal. So that will stabilize sentiment. And with the consumer slowing down, that sort of prompts a relatively disappointing outlook for the US economy by the end of 2020.
Yeah, and so therefore you see the 10-year Treasury yield at 155 handle by end 2020. What about credit? I mean, spreads are so tight right now on investment grade and high yield. Do you expect further spread tightening, or could we see a little bit of a blowout?
I think it's a little bit difficult to see investment grade tightening further at this particular sort of juncture. With a slowing economy and with falling bond yields, government bond yields, you'd normally sort of see a little bit of a widening of investment grade, and we think that will be the case. The yields in high yield are obviously a lot more attractive. We're in a world where there's lots and lots of low yield. So US high yield stick out, particularly when you're looking at things from a European or an Asian perspective. And I think you will see sort of some attractions, particularly in the first half, towards US high yield.
Yeah.
In the second half of the year, I think the story that we have of the slowing economy will counterbalance that. People get worried about what's going to happen in 2021 and 2022.
Yeah, in terms of worries, I was saying at the top of the show, no worries evident in what we've seen in terms of the US stock market rally. But that said, it's very rare that recessions have happened after years with rallies this large. Will we see the same sort of gains in 2020 in US equity markets if you do continue to see yields fall as you predict?
I don't think we will this time around. I think the trick in 2019 was that the scale of the bond yield fall was very sort of substantive. It's not going to be repeated on the same scale. You also had a situation where the US equity market was relatively sort of cheap. So 2018 was all about earnings expanding an awful lot and the market going nowhere. Last year was all about earnings not going very far at all and the market sort of expanding. So price earnings multiples are now rich, and we think it's going to be difficult to rally from here.